think we'll get started. Well, good afternoon, everybody. Appreciate you joining our session. I know there's a lot out there. We're winding down after two full good days, but appreciate you being here. So my name is Klujsza, Vice President of Pricing and Procurement Strategy at RXO. Been in the industry for about 15 years, spent the vast majority of my time in pricing and procurement strategy on the brokerage side. So today, the session we're talking about is titled The Market Cycle, Truckload Dynamics Shaping the Supply Chain. So we'll spend a lot of time talking about the market intelligence that we collect and we report on, and what that does for rate volatility in the truckload space, and then as well as some of the supply and demand dynamics that are shaping what's happening from a rate environment. So just quickly, I think it's always good to kind of level set, but we'll talk about the truckload market dynamics, talk about what's kind of happened year to date, the supply and the demand trends, and the latest Q4 forecast, what we're seeing, what we're watching in Q4. And then, if you think about from a procurement standpoint, if you're in the audience from a procurement side, what can you do? What are you thinking about during the cycle, preparing for budget season, preparing for service cost, aspects into next year, into 2026. So to start, I know it's a kind of an elementary start, but I think it's always a great way to just kind of set the table. The truckload market is massive, right? Over $987 billion in annual shipper spend. It's dynamic. Low barriers to entry and exit from a supply side, and then certainly fragmented, right? Millions of market participants across the board from supply, from shipper side. When we go into this and we look at really what's making up the truckload supply, 577,000 motor carriers are estimated around there. About top 15 control, roughly 10% of the market share. And then when you think about, again, how fragmented this market really is from a supply and a capacity standpoint, 99.6% of those MC authorities out there operate 100 or fewer trucks, and 95.5% operate 10 or fewer trucks. And it's just the same on the demand side, right? Millions of manufacturers, wholesalers, importers, exporters, retailers that make up the market. And just, for comparison's sake, just thinking about what the truckload market is to the parcel market, you can think about the biggest carriers' market share on the parcel side, almost 40-50%. The truckload market, nowhere close, right? One top carrier makes up less than 1% of the truckload market. So when we think about rate volatility in the market, we like to use what's a proprietary, what we call the RXO Curve. And you can look back, we've been measuring the cycles of the truckload market for almost 20 years now, going all the way back to 2007. And no market is the exact same, but the patterns are typical, right? And understanding where we're at in the cycle, they tend to repeat themselves. So when you look back, right, the first 4 cycles since we've been kind of measuring the RXO curve, it typically lasts around 12 quarters, and the peak is somewhere around about 25 to 30% year over year, and then the trough, somewhere closer to probably 15 or 20%. Now, we'll get into this, but cycle 5, clearly different. We're coming out of cycle 5, all things driven by COVID. But that kind of gives you an idea, again, how repeatable this is moving forward. Where are we at today, and what does the future look like as we go into 2026? But to break down a cycle from start to finish, I think it's really important. So what we're measuring is the start of a cycle is when line haul CPMs, so exclusive of fuel, line haul CPMs in the truckload market are at equilibrium year over year. So what we're looking at is proprietary RXO move load shipments. It's over 10,000 loads a day, split between van and reefer, but a diverse market set that we think really gives us an idea of what's happening in the overall market and the overall cost per mile and rates in the industry. So we're measuring the quarterly average on a year-over-year basis, again, exclusive of fuel. And so when we start the cycle, we're at equilibrium. That means that we're as close to a supply and demand balance as you can get. Historically speaking, we don't live in this environment very long, but what we tend to see happen is that demand on the upside, demand starts to outpace supply. So we start to see some rate inflationary metrics year over year. Eventually, at some point, supply catches up to demand, we get a peak, and we start to roll back over on a year-over-year basis. So we're still inflationary, but in a decelerating market. You get back down through equilibrium, you get to a peak, or to a trough, and then back up towards back up towards equilibrium as demand is catching up. So again, as we think about that, the average cycle is roughly about 12 quarters, but we think about that from start, equilibrium to peak to trough, back to equilibrium. So 2025 to date, I think we need to talk about kind of what's been happening as we go through this and get an understanding of where we're at in the current cycle. So what we've done is we've taken a small snippet, the last 2.5 cycles. We've entered cycle 6, about Q2 of last year, at least from our side, we entered cycle 6. But what you can see is the green line on the chart is the RXO curve. So again, that is the measurement of line haul CPMs in the market year over year. And then what we've also done is we've overlaid that with, pretty importantly for this room, and as you're thinking about procurement, the Cass line haul index. So the Cass line haul index, we think, is the best proxy to what's happening in the contract market. So the big thing here is the relationship between transactional rates in the for-hire market versus what's happening on the contract side. So you can see there's a stark relationship between when the curve intersects with the Cass line haul index, either on the upside or the downside, you start to see the contract environment behave or react about 2 quarters later. So currently, to date, we sit at Q3 from a transactional side. Spot rates are modest, about 2.2% up year over year. And when we crossed over earlier this year, on the upside, and we went inflationary, you started to see the contract landscape react, right? We saw the first inflationary print on the Cass line haul index for quite some time, over 2.5 years. But again, kind of this modest move, from about 1.5% in Q1 to currently contract rates sitting up about 1.8% year over year. The one thing I think we just started to kind of prop this slide up. It's actually probably been a little bit now, but I think when we first introduced the curve, it's sometimes difficult to kind of relate and think about those peaks and those troughs and what's happening in real time. And so what we've tried to do on this chart is we've overlaid the RXO curve. That's the historical green line. And what we've done to try and give viewers and people that are thinking about this data, the black line, I think, gives a little bit more clarity to what's happening sequentially in this market. And we've also included this as a all-in rate, so it includes fuel, right? And one thing that we're doing, just to explain the black line on the chart, we've indexed all-in CPMs in the market, in the truckload market, back to 2015. There's no real significance to that year. It's just kind of the middle part of the chart. But what's really important here for us is that this kind of gives an idea of what rates have done from an all-in perspective over time. And when we look about at the peak of the last cycle during COVID, what that's saying is that all-in rates in the for-hire and the transactional market were actually up 78% compared to 2015. And now we start to see, okay, after the demand was coming out of the environment, we'll get into the kind of the demand patterns and the consumer sentiment and the consumer goods and the share of goods versus services. But we started to see demand kind of roll over. And what we've seen for the last 2 years is a very flat environment. You see that on the curve year over year, we're kind of at parity. But again, the most important thing for us right now, when you think about how difficult it is for the capacity in the market, what this is saying is that rates are only up 16% compared to 10 years ago. That is without a doubt what is driving exits from a capacity side on the truckload market. So what we know about operating costs for the average carrier in the industry is that over that 10-year period, costs are up about 34%, about 34 or 35%. And the rates, if you're subject to playing the for-hire market, or if you're not kind of playing in the contract space, you're subject to seeing rates that are only 16.5% higher versus 10 years ago. This is putting a huge constraint on the operating cost for the carrier base, the average carrier in the market, which is driving capacity out of the market. Another thing when we talk about rate volatility, and I think about, what as a procurement professional, what is going to drive kind of routing guide deterioration or service or any of those issues that, we experienced during COVID or you experienced during an inflationary period. We also like to track what's called either the spot to contract premium or discount. So this is, again, proprietary RXO data. So as a for-hire carrier, our data set is a little bit different. You've probably seen this chart or this relationship in other publications. But for us, what we do is we measure the difference between the contract rates that we have in our system and what's in the spot market within our system. And until we start to see a change in behavior for spot rates moving at a premium to contract, there really is no call for extreme volatility moving forward. So I should level set and again say, this doesn't mean that if you're a procurement professional and you're running a Los Angeles to Chicago corridor, that you could get out of the contract market and automatically save 12.5%. This is a different data set. But what's important is, again, the relationship about how we think about when procurement professionals can think about the service deterioration or some of those different things that are happening. But right now, over the last kind of quarter or quarter and a half, we've seen a continued move to the downside. Now, part of this, again, is because contract rates are slightly inflationary year over year, but that demand environment over the last kind of 60 to 90 days, as we kind of got out of Liberation Day and tariff and some of those uncertainties, which we'll get into, has widened this spread. And so in order for us to really think about rate volatility in the market, the historical average, when you start to see that, is that spot rates are moving at a premium by about 6%. This is when you start to see undisciplined carriers in the market chase spot rates. They'll jeopardize kind of service relationships or relationships in the contract side to go chase more money. But I think this shows kind of the spread and the difference between what's happening on the contract and the spot side as we think about rate volatility. And then what I will say is, again, over the last, I think it's kind of, as the freight recession overall kind of continues and we're in this difficult backdrop, I think it is important for us to just kind of overlay what's happening for RPMs in our industry over the last 3 years. Again, we've talked about rates being inflationary. So what's happened so far this year is that we had a really, kind of a muted kind of Q2. And as we got into tariffs and Liberation Day, we started to see demand kind of wane, a soft Q2, but an interesting move over the last kind of 30 to 60 days in which, RPMs and CPMs in the industry are starting to outperform. And when we talk about pretty soon about the supply and what we think is coming back closer to equilibrium, we're starting to see CPMs firm up, particularly with some behavior that is a little bit different this month and maybe potentially heading into the rest of Q4. I think this kind of sets the backdrop, at least as kind of an overlay as where rates are today versus last year versus 2023. So kind of set the table for rate volatility. I do want to jump to the supply side. And again, I think, it's no secret. This is a very, very difficult backdrop for the carriers that are in the market. We have seen carrier operating authorities, the way that we want to measure or think about measuring in one way what's happening on the capacity side are the MC carrier operating authorities in the market and whether they're increasing or decreasing. So certainly, again, when you're on the upswing in an inflationary environment, we start to see carriers entering the market, low barriers of entry. When we're in this kind of trough or climbing out of the trough, that is when we're seeing all the pressure on the supply side with carriers exiting the market. So that trend has been 30 out of the last 36 months with a net decrease over that time of about 50,000 carriers, roughly about 4% of the total capacity in the market. Now, what's interesting, I think we should kind of, set the backdrop for what's going on in that data, right? What's happening from a weekly carrier authority change. You can see, so the green line, the chart on the left, the green line is the average exits per week for the 2023 and 2024 period. And you can start to see that 2025 is elevated, right? We're coming back, lower carriers, the amount of carriers, I think, that are exiting on a weekly basis is slowing down, giving us an indication that we're getting back and much closer to an equilibrium from a supply and demand side. But what I do think is interesting, and the way that we look at this and the way that we think about this, when carrier exits are reported, there's three ways that they're reported. They're reported as new grants, a brand new MC into the market that didn't exist previously. There's reinstatements. Reinstatements are MCs that had gone dormant and are coming back and being reinstated in the market. And then there's overall net revocations. It's just carriers leaving the market in its entirety. So we've started to see net revocations slow down, right? That's kind of getting us back to parity, back to equilibrium a little bit. But what's been really interesting in the underlying, metrics of this number are the reinstatements. So earlier this year, around kind of the middle to end of Q1, we started to see reinstatements pick up. And that is a very interesting kind of thought process as we think about what's going on from low rates and the pressures that the supply side is under. But we'll get to what we've kind of called the private fleet effect. And what we really think is starting to happen from a supply side is that drivers are being released back out based off of, kind of optimizing fleets, optimizing the larger assets, and drivers being released back out into the market in which they have no, some have a choice, but most don't have a choice to go back and reinstate a previous MC that they were working with. But so that's been an interesting kind of look into seeing what's been really happening from a capacity side standpoint, from a reinstatement theory, and we'll get more to that from some of the supply side and what's happening with the private fleet. And then on the right side, the Class 8 truck orders. We always want to track this. We always think that Class 8 truck orders is a good leading indicator for what's happening on the supply side, right? When you see Class 8 truck orders growing on a year-over-year basis, that gives us an indication that supply is coming in. What we've been seeing over the last couple of months and quarters is that number is certainly starting to slow. And we were thrown off, again, when you look at this chart back to, 2022 and those high numbers. What was happening during that time was, certainly COVID. Rates were at all-time highs. Carriers were trying to enter the market. They were ordering new trucks. And really, there's kind of this hangover effect. We couldn't get them, OEMs couldn't produce and push out truck orders. So there's kind of this hangover effect. But over the last, few months, we've really started to see, Class 8 truck orders slow, which, again, provides a little bit of a difficult backdrop for the capacity side when you think about the age of fleets, maintenance costs, all of those different things that are going into the supply side of the market. Freight market conditions, I think it's really important for us to talk about, what's happening even in a low rate environment. We're starting to see KPIs kind of firm up. Again, kind of a further indication that this market is getting closer to equilibrium. Dry van, load to truck ratios. I think this is a great metric that we try and track, but they're elevated, right? They're elevated to 2024 levels. And then when you start to think about outbound tender rejection rates have been higher this year than at any point in 2024 and at 2025. We think that trend continues. But that's been an interesting kind of dynamic as we think about how carriers have kind of optimized their fleets, the way that they're pricing, the way that they're thinking about accepting the tenders that are coming to them. In reality, where I think we're starting to see this number firm up, because if you're optimizing your network and you take a load and you're hanging a driver out in an area that you're maybe subject to taking a backhaul for, the reality is that the rates that you're getting in the for-hire market to take that backhaul are unsustainable rates. They're unprofitable rates. So we're really starting to see carriers think about the freight that they're accepting, and that's elevating tender rejection rates versus 2024 and 2023. I want to get back to, again, we kind of talked about it before, but I want to get back to what the private fleet effect was. And this is really what I kind of think is prolonging this kind of freight recession and what we saw coming out of COVID. So certainly when we talk about rates in COVID peaking at 78%, there are a lot of shippers in the community that own their own private fleets. They were subject to going to the for-hire market for spot loads, for pent-up demand, and paying a premium out there in the for-hire market. So what we started to see kind of towards the end of 2023 and the beginning part of 2024 is that private fleets and shippers that own private fleets were really starting to grow their supply, thinking about insourcing the volume into their own network and not being subject to play in the for-hire market. So this has had compounding effects on, again, the overall supply and, more importantly, the overall rate environment and demand that's going to the for-hire market. So you can see what we've done here on this side, ACT chart, but the black line is the freight composite and the blue line is the private fleet freight composite. You can see that started to elevate towards the middle and end of 2023 and has stayed elevated through 2024 with a slight decrease this year. But more importantly, when you look at the green line, that's the volume that's falling to the for-hire market. That's the volume that's leaving the in-source within the shipper's network And that's what's kind of keeping rate volatility pretty low. Until we think about or we see the for-hire market and the volumes and the demand trends in the for-hire market changing, that's when we start to, again, that's kind of another metric that we're watching to think about rate volatility to the upside, inflationary pressures, continued inflationary pressures to the upside. But again, a really important theme. And what we're starting to see is that, again, based off the reinstatement data, and you can kind of see the 2025 trend coming down to the lower side, to the lower end, still inflationary year over year, but it's giving us conviction that they're starting to unwind a little bit of that capacity, right? You're thinking about insourcing. It's very expensive to run and to operate your own private fleet, higher insurance costs, all of those different things. So what we've started to see is that number kind of wane year over year. And then couple that with the reinstatements that we saw on the MC authorities, we have conviction that some of that capacity is leaving the private fleets. And is this trend going to be different heading into next year? I think that picture is already a little bit different over the last quarter or so. Another thing we talked about, Class 8 tractor demand. I do think, again, it's important to show, it's usually a leading indicator for the supply side, but we have continued to see contraction consistently since the middle of 2023. That kind of tracks with the overall spot rates in the truckload market. And industry forecasts, I think, again, continue to project soft sales through most of 2026. But reality, what this does, again, it impacts the average age of the fleet on the road. It increases maintenance costs. It puts continued pressure on the capacity and on the supply side. And I think the last thing that I think is worth calling out, I think it's still too early to tell, or the picture is not as clear as it maybe was before. But there is regulatory policy out there for 2027 emissions. And could that trigger pre-buys to tractor sales, kind of pushing this back up? I think that picture is a little cloudier than it had been before, but certainly hanging out there in the balance for when we get to 2027 and beyond. From a demand side, again, I think, we want to continue to talk about this until this trend changes. We've seen a continued downside trend on volume to the for-hire market, compounding with the private fleet effect that we already talked about, compounding with all of the, consumer kind of headwinds that are out there, from a demand side. But currently, for-hire shipments to the for-hire market in the latest publication are down about 9.3% year over year. That is a year over year low for the year. And then when we continue to think about that, again, continued contraction there for 3 years. And then shifting consumer patterns and freight insourcing have been the two biggest drivers, we think, for volume to the for-hire market and what that's doing for rates. One thing that I think is important and what we saw going into the end of 2024, and as we think about peak season and what Q4 of this year can bring, I think there was some hope last year that the truckload market from a rate side was really starting to rebound. And in Q4 of last year, we started to see some increase in rates in the industry. We started to see some service failures. We started to see some indications that potentially this market was really changing. And when we look back at what was happening, and we get the question a lot is, well, on the curve, you started to show this inflationary move, what stopped the momentum? And I think about, from a tariff standpoint, I think this timeline is really indicative to the way that the market behaved from a demand side going into the end of last year and what kind of played out in Q1 and Q2 of this year. So I don't think this is, surprising to anybody from the chart. But what we started to see last year was the shippers that could, for the materials or anything that had a longer shelf life, volume was really starting to get pulled forward in the market. It was causing a higher demand. There wasn't enough supply. We're closer to equilibrium. And then rates started to go higher. But once we hit Liberation Day, we started to see kind of inventory to sales ratios roll over, and it kind of stopped or it was a pause, right? Overall demand, and kind of this easy, kind of smooth handoff for demand that didn't keep the momentum going in the rate market from the end of Q4 of last year into Q2 and Q3 of this year. But I think this kind of gives an idea of the relationship between this chart and what happened to inventory to sales ratios. Back half of last year, we started to see inventory rising, albeit at a slow at a slow rate, modest rate. And then when we hit Liberation Day, we started to see inventories kind of pull back down, right? The uncertainty was out there. People weren't sure about what was going to happen. The picture is a little bit clearer now. But, can this be, as we think about inventory levels kind of, coming down, can it be some pent-up demand into the back half of the year and into 2026? I think it, still remains to be seen, but this is kind of a really important chart as the way we think about what happened with rates, volatility in rates last year, and how that momentum kind of stopped and paused in Q1 and Q2 of this year and moving forward. Consumer spending, I think, this is a really important metric that we always try and track. The relationship between services and goods as a percentage of overall consumer spending. The goods consumption in the country is really what's going to drive overall truckload demand. And we've continued to see goods consumption on a downward decline over the last 3 years coming off COVID. This chart, I know we've gone back pretty far, but this doesn't mean that a shift in this pattern has to look as drastic as it did in COVID, right? Goods consumption, you can see how out of control this kind of got from a shifting consumer pattern and consumer spending pattern, where goods were moving at 69% of overall consumption. But I think this chart really shows the relationship between what happened on the curve, what happened in truckload rates during that time, and what's been the unwind over the last 3 years. So I do think, as we look at this, the important thing here is I go back and I look at previous cycles and I think about 2017. I know it's kind of small on the chart, but a change in consumer spending from a goods standpoint, this doesn't have to look anything like the COVID relationship for rates to really start to see volatility and for there to be some momentum heading to the next cycle. But I look back in the June of 2017, we saw about a 50 or 100 basis point move in consumer spending towards goods. And that really kind of catapulted us off. You look at the previous cycle for 2017, that was enough for a 35 or 39% move year over year into the next peak of the cycle. So I think this is an important metric. We've got to continue to see what this looks like, but a modest, 50 or 100 basis point move in consumer spending can really kind of shift and change this thing as we think about the relationship for the RXO curve and rate volatility into 2026. Quickly recap from a supply trend issue. Again, continued capacity exits, but it's slowing, right? Reinstatements accelerated. We talked about that private fleet expansion in 2024, but that trend looks a little bit different now in 2025. Trucking employment, continues to contract year over year. And then there's continued high levels of driver availability. Although, it is coming back closer to equilibrium, we still feel like we're in a slight surplus from a capacity standpoint in the market. And then demand headwinds, continued tariff headwinds for the overall demand. We didn't talk about import expansion, but you can really think about when that volume was pulling forward. We did start to see, the West Coast import activity was increasing and kind of firming up towards the back half of last year and into the beginning part of this year. We've really started to see that kind of tail off and decline. I think, if you talk to industry experts that are out there that are monitoring West Coast port activity, the outlook for Q4 looks modest. We'll see what happens, but that's kind of been the demand trend that we've been watching. Private fleet growth in 2024, continued to drive that volume insourcing, the inventory to sales ratio, and then again important, the ATA truck tonnage. It was relatively flat in Q2 of this year, remains relatively flat, but again, that relationship for the volume that's falling to the for-hire market versus what's staying insourced is really what's going to change the rate environment in the truckload space. So what we're watching in Q4, that spot to contract premium, again, rate volatility won't come until spot is moving at a premium to contract. The curve versus cast, that relationship, right? We talk about the curve kind of rolling back over, from that peak in Q4 and Q1 of this year, getting closer to equilibrium. But the reality is we feel pretty strong that there is not much room for rates to go to the downside. So does that continue to see an uptrend driving contract rates into next year? And then, peak season demand. I think it's a little too early to tell what peak season demand looks like this year compared to last year and that volume pull forward and some of those dynamics that were out there. For higher volume trends, continuing to see if that trend can reverse. And U.S. diesel prices, I think, this is a really interesting one. on the broker side, and really if you're on the capacity side that's subject to play in the for-hire market, Q3 of 2025 is set to be the first inflationary print for U.S. diesel prices on a year-over-year basis, set to be the first inflationary print since Q1 of 2023, so about 2.5 years. Well, the way we think about the relationship for diesel prices in the truckload landscape, in the contract environment, not really a big deal, right? We do understand, it's higher revenue, but it's mostly a pass-through cost. What we see happen on the for-hire market in a rising U.S. diesel, inflationary environment is that if the overall, if the overall rates in the market don't move with an inflationary, continued inflationary pressures on the U.S. diesel side, all that does is continue to put pressure on the operating costs and the line haul costs that fall to the bottom line for the carriers that are in the for-hire market. So if we continue to see that trend, it's unfortunate, but it's a continued pressure on the supply side that could continue to drive capacity out of the market. I think it, again, remains to be seen if we continue that trend into Q4 and into next year, but it is a change in what's happening for diesel prices today compared to the last, again, it's been 2.5 years since we've seen an inflationary environment there. And then this cycle versus previous, I think we talked about, the peaks and the troughs. This cycle kind of coming back down towards equilibrium driven by, a rise in fuel prices and an overall demand. But what does this cycle look like as we head into 2026, the peak and the trough, and whether or not we get to those highs and those lows? I think given, the industry backdrop and everything that's been happening from a supply and demand standpoint, there's nothing really changing there. So I think we will get back to an environment where the cycle is kind of firmed back up to like kind of 12 quarters, those average peaks and those troughs. But we're certainly in this holding pattern as we've unwound from COVID, which was the highest peak, highest trough that we've seen in the 5 cycles that we were measuring. So, what can you do? I think as we set the backdrop for what's happening in the rate space on the truckload side, around this time last year, and I continue to show these slides because it rings true today. The truckload market hasn't changed, too much. Obviously, a lot of things are happening, but from a rate side, it's been a pretty flat environment like we showed on the chart. But we ran a study last year with, about 500 carriers and 500 shippers. And we wanted to align on what the expectations are for carriers and shippers in the truckload market. So, what can we do? And we think about the KPIs that are out there, but, keeping your routing guide in check, I think goes without saying, flagging potential problems. But this cost versus service balance at this part of the cycle is vital, right? Chasing cost savings in an environment where we know there's so much pressure on the supply end, exits are continuing. What is that cost versus service balance as we go into this? Assessing your overall risk, right? How much are you out there, from that balance? And then leveraging APIs for visibility. I think that this has been, a really important trend that we've started to see in the truckload market is connections, API connections to your carrier base to understand what's happening in the for-hire market, in the spot environment versus the contract environment. This is a really important tool as you think about visibility to data and everything moving forward, leveraging the APIs. But one thing, getting your KPIs in order, this is, again, feedback directly from carriers that were pulsed. 95% of carriers said that inefficient shipping practices impacts the rates that they give to customers. And even furthermore, 99% of carriers take shipper KPI expectations into account before they agree to a rate. So I think this is really important. And I'll quickly jump to the next slide because this is also, with the carrier base and as you think about the KPIs that are out there for visibility between carriers and shippers. But I tend to push towards the right side of the graph because 500 carriers just over a 2-year span said that the industry standards, that they should have industry standards for KPIs have grown from 74% of carriers to 90% of carriers. They are in tune with the market more than they've ever been before. The data is available, the data is visible, and I think as you think about best practices on the carrier side and getting a standard set of KPIs to hold carriers and shippers accountable is really important to both sides of the equation, right? The shipper and the carrier community. To kind of finish up and wrap up, the last parts of the industry standards, pickup performance about 95% on time, 95% on time for delivery. Primary tender acceptance, the average acceptance rate that we got in the survey was about 85%. And then here, I think is a big one, 10% is the variance from volume and the volume forecast, right? Carriers are starting to take into account what we had kind of called historically like fill rates, right? What are you awarding to the carrier base? Are they seeing the volume? Will that grow, and uphold the service and the rate commitments that they've given you? And then the last two that we throw up, payment terms within 1 week. I have to put a caveat there. The expectation here is that once invoices and bills pass, freight bill and auto pay, the expectation is a carrier expects to be paid within 1 week. And then the lead time for carriers, best practice for lead time for carriers in the market historically has been about 48 hours, for a tender. So I think we'll kind of wrap there. I don't know if any questions or answers, but again, I hope, from our side, when we think about, what's driving the truckload market overall, some really important trends from a, supply and demand standpoint that we continue to watch. And then again, what can drive or what can be that next kind of catalyst to an inflationary market. I think when we continue to look forward into Q4 and into next year, we kind of envision this, continued kind of stair step. Unless there's a demand shock that's out there, this next cycle is really driven by the supply side and the pressure that the supply side is under. I'll stop there. I don't know if there's any questions.
With the advent of AI playing a huge role in routing software, has this gone into any of the benefits or the metrics that you're seeing?
Yeah, I think we get that question a lot, right? And it's more so around, what does that do to rate volatility? And I think the answer right now is that it's still a supply and demand, right? So from an AI standpoint or from an LLM standpoint, the ability to get a quote faster is what's going to drive and help, on a carrier side, giving the rate back to the shipper community, honoring that rate, getting market intelligence in there. But what does that do to a change in the overall kind of rate volatility, right? I think the question usually becomes, will the peaks be muted and will the troughs, be lower than what they were before? I don't think we see that moving forward, given that it still just remains a supply and demand standpoint. But the ability of AI, the ability of LLMs to continuously or synchronously give quotes back to the shippers, that's what's going to drive that. So it's going to drive continued kind of market intelligence to uphold and understand the sharing of data across the community from the carrier and the shipper standpoint. Yep.
Is there a group already leading the initiative for industry standardization for you guys? Or is that just you faxing shippers and figure that together to do that? How does that work?
Yeah, it's a good question. I'm actually not familiar with a group that is kind of trying to standardize that. I think, we brought the study to light because it's necessary and it's needed. I think events like this are great to try and get together and provoke thoughts on that. I'm not familiar with a group that's trying to do that. I don't know if anybody on the RXO side has any insight there. But.
The last couple of years, van reefer and open deck have kind of been playing by the same dynamic. And as you know, historically that wasn't really the case. They often moved. They're often pretty different. And I think we're trying to keep an eye on when do those diverge again. And other than looking at interest rates, which will spur industrial and housing for open deck, is there any other way you're thinking about that or things you're keeping an eye on as you monitor the different equipment types?
Yeah, I think, the consumer patterns matter, right? And housing, you particularly think about flatbed market when you talk about kind of the housing, the manufacturing. Until some of those trends change, I think, you're right. We've been continuing to see those patterns from a dry van, from a reefer and a flatbed standpoint kind of go hand in hand. But there are certainly, seasonal patterns, divergence in that way. From a flatbed side, I think, you've got to focus in on housing if that is going to change. Can a drop in interest rates drive some housing demand that's out there that could, continue to push up or change the flatbed, kind of relationship to the dry van or reefer side? Haven't seen it yet. but I certainly think those are some of the metrics that have to be watched. The food and bev, seasonal for dry van and reefer always, stays close to mind. But that trend, we saw that in Q2 when you think about kind of the food and beverage seasonal trends in Q2. I think when you go back to what happened for rate volatility during some of those capacity constrained events, I think about like kind of a DOT road check week, July 4th, we did see the market bounce and react, I guess I would say favorably compared to seasonal patterns previously, but they retreated so fast after that, right? There wasn't enough momentum to hold. So I think that's kind of the relationship that we're seeing. They're in lockstep right now. Can something trigger and change that? From a flatbed side, I think it's, some of those metrics from housing and manufacturing, but nothing yet.
RXO acquired Coyote. How was that going?
Very well. Yeah, very well. We just celebrated, 1 year, 2 weeks ago? Yeah, so the cross-pollination, I think when, I was being asked this question, early on in the integration, my response to that was like, it's kind of like looking in the mirror. We've really found, working together, we were two similar groups that were coming together. So celebrating 1 year, we're feeling very good. Our systems and our coverage are near completion for integration, but very well so far. Yeah.
Do you guys have any index on carrier going out of business? I mean, by the end of the year or something where you guys track every month? I mean, right now with the market as it is right now, that is shaking down.
Yeah. Yeah. Again, from a carrier exit, we try and look at it from an MC authority level. We understand that that's not perfect, right? Because when you're tracking an MC authority level, you don't have the greatest indication if that's one owner operator or if that's, 200 or a 300 truck outfit. So, there's difficulties in the data and tracking what that is. But when you look at further employment numbers, I think you can kind of drive down from the, carrier exits, right? It's slowing. We kind of went through that. It's still happening. They're continuing to exit the market. But I think when you couple that with overall employment in the market and that contracting, it's still going to always be owner operators on an MC level make up a majority, or I should say, I think it's maybe roughly 15 or 16% of MCs. But when you think about the employment and coupling that relationship with the employment numbers contracting, we're starting to get an idea that there are some larger, mid-sized carriers that are under these pressures. Unless something changes on a demand side, from a fuel standpoint, from a demand headwind, that pattern is most likely going to continue heading into the back half of the year. All right. Well, thank you so much. Really appreciate everybody being here.